But if you're a trader and you're in and out in a day, then you
think that's great.
It's brilliant.
Right. And that's why Buffett says if you're a long-term buyer of stocks, right, you want to buy them, you want them to be cheap. But he's saying cheap in relation to the value, right? I.e., what's the value? The earnings yield. So Buffett's saying when stocks are yielding 10%, as he says, reach for a bucket, not a thimble.
Yeah.
Right? Because they're yielding a lot, regardless of the capital gain.
Yeah. Yeah. A stock can be cheap and not be yielding a lot still.
Yes.
Which
So
is,
it's
I think,
just,
where people get mixed up.
yeah, you've got to look at the yields, which is two components, which is the income part and the capital gain part. What we see in the stock market in the next slide, we cut half this chart off, unfortunately, but what you see there is the differences over time of the return of the yields, right? And so that's why, and we use this chart quite a bit, because what we're showing people...
So the red line that you can't see is annualized real return.
Yeah, over 10 years, right? And so we talked about this, I think, in last session, where saying...
2 sessions ago, yeah.
Yeah, where you look at 2000, the yield was really awful, but you'd had an 18-year bull market in capital growth.
Yeah.
Right? So from 2000 to now, 2025, January, you've earned roughly about 4.5% compound, which is not that great, right? But if you bought in 2009 when the yield was really high, you've done really well.
Yeah.